In the courts of the great kings, when aristocracy reigned, nobles were perpetually vying for favor from the king. Kings can be capricious. However, a favorite noble can quickly be ousted from favor on a whim, while another, newer, shinier noble takes his place. Such is the stock market, an irrational king favoring and disfavoring stocks for whimsical reasons. And right now, one business the market dislikes is SaaS giant Adobe, ticker ADBE. Welcome to the Quality Investor. AI is in vogue because of businesses such as Nvidia, Google, Microsoft, and Palantir. And it seems all the tech businesses are signaling to the king's court their AI intentions. And Adobe is no different. They too want favored status in the king's court of AI, but right now the market is not buying what Adobe is selling. Adobe's flagship AI product is Firefly. Released in early 2023, it was a standalone web app, but Adobe has slowly integrated it into its product suite. While I'm not going to comment on its effectiveness, the market has been disappointed with Adobe's slower than expected revenue generation from its AI. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Many thought that AI would boost the top line and accelerate Adobe's growth. But the market seems to be disappointed each quarter as Adobe releases their earnings and guidance as investor confidence deflates. At the end of 2023, Adobe was trading right near $600, and now, 15 months later, it is sitting at $385.71 a share. The king has banished Adobe from the court of AI. The market, like kings, tend to be impatient in obtaining their desires. The market wants to see AI monetization, and Adobe is not delivering. But is that really the case? Adobe has been slow to monetize their AI. However, they are emphasizing adoption over monetization. They want user engagement. They offer a free tier to attract users. This helps entice those users to upgrade to higher tier subscription plans, especially plans where Firefly is integrated with other products such as Photoshop and Illustrator. This has an indirect impact on Adobe's moat as well. It helps to drive ecosystem lock-in. Embedding Firefly into their product suite enhances product stickiness, thus encouraging renewals. Adobe is playing the long game here. It wants creators to need its AI product, so it is enticing them with free features. By giving up small revenue gains today, it hopes creators will move to higher priced and higher margin subscriptions with AI integration later. We'll see if that pays off. Perhaps investors were expecting to see that revenue boost by now in the earning and guidance, and these lowered expectations are now being priced in. There is also increasing competition in the generative AI space. OpenAI and others are offering lower cost creative tools, making it easier for novice digital artists to create images without learning Adobe's complex software. The fear is this will put pressure on Adobe's very high margins. The announcement of OpenAI's Sora in 2024 also hit Adobe's stock price. All of this is driving the negative market sentiment around Adobe, and it has been hard to digest for investors. Already down 13.3% year to date, it is down 23.6% on a 1-year basis and down 6.1% annually on a 3-year basis. But here is the rub. While the share price has been falling, the overall fundamentals of Adobe have been improving. We'll get into the numbers shortly, but the fact is revenues, margins, and cash flow are rising. They are incredibly capital light, and that allows them to generate a massive return on invested capital. That is all in the past though. Markets look forward. Expectations drive everything, at least in the short term. The market expects Adobe to grow its revenue faster because of AI, specifically because of its Gen AI Firefly. To do that, Adobe needs two things. It needs adoption, and then it needs to upgrade those adopters to higher tier subscription plans. To drive adoption, Adobe is offering a free tier to Firefly. It lets users experiment and get used to the tool. Adobe says more than 20 billion assets have been generated since its March 2023 launch, and that 90% of the web app users are new to Adobe's products. As Firefly is integrated into more of its product offerings, this will drive new user adoption to Adobe's ecosystem. Goldman Sachs indicated that only 125 million in revenue is brought in directly from AI products, and that is expected to double this fiscal year. They are claiming AI influences, however, 3.5 billion of Adobe's annual revenue. This underscores Adobe's rising engagement of Firefly and bringing more and more users into the ecosystem. Adobe is also increasing enterprise adoption. While Adobe's Creative Cloud is used by individuals and small businesses mostly, it is expanding its reach to large organizations with what it calls commercially safe content creation. It is trained only on licensed Adobe stock and public domain media, thus providing IP indemnification and reducing legal risk. Bringing large organizations into the fold will certainly increase Adobe's average revenue per user. Another push to increase revenue is shifting towards usage-based pricing. Users use credits to create AI content, and each subscription tier offers a certain amount. Charging a user for additional credits will also generate more revenue growth. Adobe says that usage is up 2.5 times year over year. With a clear picture of how Adobe seeks to monetize AI, what do their fundamentals tell us? Is this company worth buying at today's price? Let's dive into some financial charts and then assess what their discounted cash flow is to get an idea of what their true intrinsic value really is. Adobe went into this weekend trading at $385.71. And we can see that's not too good year to date. You can see it's red, and it seems like it's going to continue to be like that for a while. Right here, you can see a huge drop. They dropped over 10% at their latest earnings that came out on March 12th. Zooming out to a one-year basis, though, you can see every 3 months or every single earnings release, Adobe has been suffering quite a drop in the market. And they seem to recover a little bit, but not enough momentum to really overtake the original drop. So clearly, the market's not liking Adobe right now. But like I said, their fundamentals are very good, and they're getting better. On the Quality Investor, we like to look at what businesses are actually earning. Are they actually earning cash? Not only that, are they compounding that cash? Is there a sustained trend of growth year over year for a very long period of time? Do they have solid balance sheet fundamentals? Like, for example, the debt to equity for Adobe sits at just under 0.5. They have more cash than they do total debt. And right here, we can see with Adobe a clear uptrend with revenue, gross profit, and operating income every single year. While it is certainly true their revenue growth has slowed, I do believe as more users engage with Firefly, adopt their AI platform, and thus turn into paid subscribers, get locked in to Adobe's ecosystem, we are going to start to see that faster growth. Adobe has said they are prioritizing user engagement and user adoption over monetization right now. Once they shift to prioritizing monetization, I believe we're going to see increased revenue growth. But despite that, they are growing all of their important metrics very consistently. But of course, what I think is one of the most important things to look at is free cash flow. And we can see that has compounded beautifully over time. And they have their highest free cash flow on the trailing 12 basis here at $9.2 billion. But what's even more important is they barely have to reinvest any of that free cash flow back into the business to sustained continued growth. But right here, this chart on the bottom right, market capitalization, tells an opposite story of what all the other fundamentals are telling us. While revenue is growing up, cash flow is going up, market capitalization shows us since fiscal year 2021, they are going down. And we see that reflected here with that 6.2% CAGR, negative CAGR really, in Adobe's share price return, and then on a one-year basis, 23.6%. And that has Adobe trading at a 25.4 PE ratio as of today. For a business like Adobe, that's incredibly low. So just looking at this, I think there's some real value here on the table. But let's dig a little bit deeper. This is some of Adobe's expense metrics. Sure, cost of goods sold on a total basis is going up, but that's to be expected when revenue grows. What's important here is this cost of goods sold margin. That's decreasing, meaning their gross margin is increasing. And same with SG&A. We can see it's growing over time, but the SG&A margin as of gross profit has been decreasing over time. So for every dollar of gross profit Adobe earns, 37.9 cents goes to pay overhead. R&D, remarkably, has been flat. R&D margin sits at 20.5% today versus 21.3% 10 years ago. But the one metric that really caught my eye here is the capital expenditure. This is already a very capital-light business. On a trailing 12 basis, they've only reinvested $172 million back into CapEx. More importantly, that's a staggering 2.59% of their NOPAT, or net operating profit after taxes. And that line has been trending downwards for 10 years. Like I said, very capital-light business. Capital-light businesses can generate very high returns on invested capital because it takes very little capital to sustain their business. And that's what we're seeing right here. Gross margins trending in the right direction over the last 10 years. Operating margins trending in the right direction. Free cash flow margin trending in the right direction, now sitting at over 40%. But right here, return on invested capital, ROIC and ROCE, both have been trending upwards over the last 10 years. ROIC sits at a staggering 88.8%, and ROCE, return on capital employed, sits at 45%. Not only does this reflect the capital light nature of the business, it reflects a management's ability to generate return on the investments they are making. And over time, we can expect the share price return and the ROIC to converge. Well, is Adobe cheap though? Well, let's look at some of their ratios here. Price to earnings ratio, we can see, is trending downward over the last 10 years. It's sitting at just over 25 now, but at the latest earnings, it was at 28.9. Price to free cash flow, it's sitting at 20.9, meaning you're paying $20.90 for every dollar free cash flow that Adobe earns. Historically, that's incredibly cheap. The one-year average for price to free cash flow is at 29.49. Their 10-year average is 34.85. EV to EBITDA ratio, 20.6. Also very historically cheap. 10-year average for that is at 35.13. Their 3-year average at 29.25. And now the earnings yield, you can see the earnings yield is also growing. The earnings yield is at 3.46%. So investors can expect about 3.5 cents of earnings for every dollar that they have invested. Now that doesn't seem high, but compare that to their 1, 3, 5, and 10-year averages, and it's well above those currently, over 1% more than their trailing averages here. And the same can be said for free cash flow yield. Free cash flow is at 4.8%. That too is well above their historical averages. So Adobe right now is certainly looking cheap based on its ratios. The fundamentals are also telling us that this is a very strong business. But like the rest of the market, we still care about what the future holds for Adobe. We want to see free cash flow growing over time so we can discount that back and see if we're paying a price today far below its true intrinsic value. If we do that, we're going to get a very healthy return. So these are the estimates I have over the next 10 years for Adobe. The bear case revenue growth I have is at 7%, base is at 8%, and the bull case is at 10%. And this is factoring in that Firefly monetization. The operating income I'm projecting over the next 10 years, I'm projecting the margins to hit 34% on the bear, 36 on the base, 38 on the bull. And we see here the operating margin on a trailing 12 basis is at 36.3%. Net margin, much the same. Earnings per share, I'm projecting 8% growth over the next 10 years for the bear case, 10.7% growth on the base case, and 13.9% annual growth on the bull case for earnings per share. So ultimately it comes down to free cash flow. Over the next 10 years, I'm projecting free cash flow to grow 6.56% on the bear case, 8.78% on the base, and 11.76% on the bull case. And this assumes for the base case that for every dollar of net income, they're converting $1.34 of that into free cash flow. This will ultimately give us a free cash flow margin of 38.67% on the base and 42.76% on the bull. This trailing 12 free cash flow margin is historically high, and the 38.67 is right around its 5-year average. So these are the growth rates I'm projecting. In my opinion, very conservative. Even for the bull case, I'm projecting their revenue growth to be in line with what we've seen over the last 5 to 10 years. So what do the final numbers look like for Adobe? Well, we already established they're trading at $385.71 as of Friday going into the weekend. That is a very low PE ratio of 25.4, well below their 5 and 10-year average. Their forward PE also at 24.4 and far below their 5 and 10-year averages. So my growth rate projections give us a bare discounted cash flow price of $499.09. The base case has it at $593.21 and $747.70 on the bull case. The exit multiple we have at $525.61. The comps I'm using for the exit multiple are Microsoft, Oracle, Synopsys, and Salesforce. So you can see here, even on the bear case, we have a valuation average of $508.37. That's far higher than their current share price. In fact, that's 31.8% higher. And on the base case, it's $569.55. That's 47.6% upside. And the bull case is a staggering $669.97 with a 73% upside. And for context here, that Goldman Sachs investment thesis I referenced earlier, they have their target price at $640. So without any margin of safety, my buy price for Adobe, or target price you could say, is at $579.36. It's a forward PE of 36.7, still below their 5 and 10-year averages. With a 20% margin of safety, we have a buy price of $463.49. And with a 30% margin of safety, a buy price of $405.55. And Adobe is currently trading below that. So we are getting, I believe, some very good value. And this is based on very conservative growth rates for revenue and free cash flow over the next 10 years. So I believe there are very good things ahead for Adobe if monetization of their Firefly product goes very well. The company is saying they're seeing high user engagement, which is turning in to adoption via subscriptions. We certainly want to see that trend continuing, but with Adobe focusing on engagement and adoption now versus monetization later, perhaps those high revenue guidances that the market wants to see will come in the next few quarters, maybe even fiscal year. But even without that, I do think Adobe is a very good value. They are a cash flow generating machine, bottom line. They're compounding it every single year. And they already have a very sound business model and a high economic moat with their current product offerings. So I think Adobe has a bright future and is very undervalued as an investment. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.